Right. A warm welcome to all of you. Good morning and thank you for joining. We also have here Haritha and Minhal. You can say them hello. They can hear you.
Hello, hi. Hello, team.
Yes.
Hi.
So, I would like to congratulate you that you have selected this CMA course. Uh,
Thank you.
Having experiences is definitely, important, but experiences without certification is a problem, right?
Yes.
Because
Yes.
your experiences are tested after the recruitment in the job,
Yes.
but to apply for the job you have to show the certificate, right?
Certifications. Yeah.
And American certificate CMA is very well in demand.
Mm.
And American certificate CMA only two papers. It is easy to crack.
Mm-hmm.
My son in last September, my son is also a big guy now.
Yeah.
He
Okay.
cleared both the parts last in September, October.
Yeah.
Yeah. So CMA also is very much in demand in UAE because everybody wants American qualification. Very much in demand. Okay. And once you do CMA, you can also do SCCA with three papers exemptions. Right? If you have time after you finish CMA, if you have time, you can also look for SCCA because some employers also asking for SCCA, so you can apply those jobs. So when you have CMA and SCCA both, your area of job opportunity widens. Thank you.
SCCA is related to
UK, yes, UK same. SCCA UK, CA India, CPA Pakistan, CPA USA, also CM USA. So about me, I did my CA from India. I'm a chartered accountant and did
Oh.
CPA from New York in 2005. That time, before 2012, you have to go to USA to write exam, CPA exam. Now CPA exams are available here. But before 2012, everybody had to go to USA to write exam, CPA exam. Yeah. Okay. So, hi Vishal. Good morning and welcome. Hi Manoj.
Good morning, sir. Good morning.
Good morning. So let's start without wastage of time, further time. All right. So today, the most important chapter, the first chapter, right? Your the chapter name will be external financial statements, right? Let me take you through. These are the topics, the categories, right? And you can see there are 20 chapters, right? 20 chapters have been categorized into all these 6 categories, right? And these are the chapter details. Chapter 1, chapter 2, chapter 1, chapter 2, this category. So there are 3 categories actually. 6 categories and 20 chapters, right? And you can see the weightages, the marks, 15% from these 6 chapters. Then 15% from these 3 chapters, from these 5 chapters. So this is how the weightage, the marks break down, right? And the exams are for 4 hours, 3 hours, 100 multiple questions, and 1 hour, 2 essay type questions, right? So what is required? What we have to do? That we have to really work hard. Every day, you have to study at least 2 hours. Every day, if you study 2 hours, then 3, 4 months time, 5 months time, it will be comfortable to clear exam, right? So we are going to have classes every weekly, one class. Possibly in between, we will see, we will agree together. If we can have again one class in between, maybe in weekdays, right? Weekend class every Sunday, 10 o'clock, like today. We will see going forward if we can put one more class, maybe 2 hours class for some practice. We will see that. But basically, the classes will be on Sunday, 10 to 1. Okay. So today we will talk about chapter number 1. So chapter 1 talks about external financial statement. What is external financial statement? What is external financials? For external use. For external users. Financials can be for internal and external. Internal means for the management. External for the shareholders, for the lenders, bankers, tax authorities, right? Your exchange, regulators. These are my external financials. Hi Ajmina, good morning. Clear? So this internal financials, right? No need, right? No need of GAAP. What is GAAP? What is GAAP? Generally accepted accounting principles, GAAP. Internal financials does not have to comply with GAAP. Let's say your manager can tell, hey Minhal, can you bring me the aging analysis of customers? Can you bring me cash account? Can you bring me inventory report? Those are for management decision making. We say internal financials. Clear? And internal financials do not have to be audited. They don't have to follow any accounting principles. Clear? Now, external financial means the financials need to be audited, given to the stakeholders, outsiders, investors, shareholders, your tax authorities, right? You can say lenders, bankers, exchange houses, regulators, prospective investors. Investors can be two types. One, existing investors, and second, prospective, those who are contemplating, those who are thinking to invest in your company, they also need your financials. Media houses also, research analysts, they also need your financials. So financials required for the external users are called external financials. Clear or not? Simple? Okay. The objectives of financials, concepts of financials, we will discuss one by one. The objectives of financials, users of financials, or we are going to discuss one by one. Second, we'll talk about statement of financial position, income statement. So let me show you, when we say financial statements, yeah. Where are they? Just one moment. One moment. Yeah. When I say financial statements, what do they include? They include statement of financial position, also called balance sheet, right? Income statement, statement of comprehensive income, SOCI, statement of changes in equity, and statement of cash flows. These make full set, right? So there is no trial balance in this. So these are my financial statement. Clear? Okay. So now, first of all, we will talk about the features of balance sheet. Is balance sheet about what? Balance sheet also called position statement. What we say? Position statement. Income statement is called performance statement. Right? So performance means income and expenses. Revenue, income and expenses. Position means how are you? How are you? Position. So position statement gives you the picture at a particular date. Right? If I say how are you, it means how is your position now? But when I say how much your income, it means for how, for which period. So income statement prepared for a period and balance sheet prepared as on a particular date. So position statement as on a particular date and income statement for a range of period from January to December. Example, we say income statement, right? Balance sheet as on December 31st, as on June 30th, we say balance sheet, right? So balance sheet is as on a particular date. We will discuss about overview, accounting equation, resources, capital structure and obligations, elements of balance sheet, current and non-current, all we are going to discuss one by one. Similarly, in income statement, we will discuss about the income, revenue, gains, expenses, losses, gross profit, cost and expenses, income statement formats, all those we are going to discuss. Then cash flow, first changes in equity. What is equity? Can someone tell me what is equity? Equity means what?
Equity is profit to the owners.
Partially, not a profit to the owners.
Profit or losses to
No,
the
equity.
So it is
in
money
equity,
infused into the business by
yeah,
the shareholders.
yeah. So equity, another term is called shareholders funds. Means what all belong to them. What all belong to them is called equity. So it can be share capital, it can be retained earning,
Retained
it
earnings
can
or
be
loss.
current year profit or loss,
Yeah.
right? All it can be also treasury stock. We'll discuss. So these are called components. What we say? Components of equity. So what all belong to
them.
the shareholders, and shareholders are owners of the company. Equity means ownership. Equity means ownership. So whatever all belong to the shareholders. Now equity transactions. What is equity transaction? The transaction which affect the equity account, right?
Yeah.
Any transaction affecting share capital. Suppose new shares are issued, equity transaction. Profit is earned, getting added to the reserve surpluses, equity transaction. Dividend is distributed, equity transactions. So whenever equity account getting changed, we say equity transactions. Clear or not? Payment to supplier is not equity transaction. Why? Because supplier liability decreasing, asset also decreasing. There is no impact on the equity. So any transaction having direct impact on the shareholders, we say equity transactions, right? So share capital, treasury stock, dividend distribution, profit earned, all are called equity transactions. Okay, next, this chapter is action packed, too much details, right? So let us, this chapter 1 should be completely understood. So I request all of you to be focused from day 1, from today, right? Then we'll talk about cash flow. So cash flow you are preparing on a daily basis, that's for internal requirement, right? And there is one cash flow also attached to the financial statement. We say statement of cash flow. So cash flow, one can be direct and indirect. This indirect is a part of the financial statement, and this direct method cash flow is for your daily cash tracking, right? So direct cash flow, the format can be opening plus in minus out. But this indirect cash flow having 3 scenarios. We say operating activities, then investing and financing. Clear? We'll discuss about it. Now consolidation. In our CMA part 1, you don't have to consolidate financials. They only have given the concept of consolidations. Where to consolidate? They are not asking how to consolidate. They will not ask you financials for many companies, consolidate. No, those are not covered in part 1. They are not in part 2 also. Consolidations is not done. It takes a lot of time. Why CMA will waste your time for consolidation? They can test you on many angles, right? So let's understand quickly. So certain things which are very, general, I will not put focus on that, right? Possibly you can read them. Now, who are the users of financials, right? Users with direct interest, we say direct users, and also indirect interest, right? We say with direct interest and indirect interest. So who are the users? They need our financials. What is direct interest? So their interest will be affected directly. Interest means what? Interest in any form can be lender, banks. Banks interest means not interest rate. Banks interest may be also affected by the financials. Similarly, shareholders, similarly, bondholders, similarly, suppliers. So we say direct interest and indirect interest. External users. They are investors, creditors, advisors, stock exchanges, regulators. Also, I write here tax authorities, let's say your FTA. So these are my external users, right? So they need external financial statement as per GAAP. Clear? So external financial, so I am discussing in our CMA, we will not discuss about LLC company financials. We will not talk about partnership company financials. We'll talk about listed companies, large companies, corporations, right? And special focus on manufacturing entities. Clear? Internal users are management and employees. They are internal users. Next. the features of financial statements, you just can read them, no need for me to go through. Financial statements complement each other. What does it mean? So, same item appears in multiple places. Example, income statement depreciation, right? And also in the balance sheet, fixed assets, cost minus accumulated depreciation. So these are called complementing each other. Now, accounting can be accrual accounting, also can be cash accounting. So cash accounting is not allowed under GAAP. First of all, let me say you what is called GAAP, right? Let's understand. What is GAAP, right? GAAP, we say local standards, right? So let's say UAE GAAP, Pakistan GAAP, and USA GAAP. Every means all the countries, right? Let's say India GAAP, right? So there is GAAP means generally accepted accounting principles, right? So every country, let's say Sri Lankan GAAP. So every country, they have their own accounting standards. So Sri Lankan companies, they have to follow Sri Lankan GAAP. Indian companies, Indian GAAP. Pakistan companies, Pakistan GAAP. USA companies, USA GAAP. But if Sri Lankan company going to Australia, so Australia, I would say, come on, you have to follow Australian GAAP. So any company going multinational, right? They cannot have financials for every country, right? So we say one called global GAAP. What do you say? Global GAAP. That's called IFRS. So if your company is following IFRS, all the countries will accept. Because Pakistan companies are gaps are different. UAE, if Pakistan company coming to open a factory or coming to IPO in UAE, so UAE investor would like to see the financials as per UAE GAAP. So in Pakistan, one financials, in India, one financials, in UAE, another. So better you be IFRS compliant. So any company following IFRS, it is undisputed. No country can say, no, this is not as per our GAAP, right? So we say international GAAP, global GAAP. So IFRS is a global GAAP. So every financials, if it is mentioned in the notes to accounts, it is mentioned that the financials are IFRS compliant. It means undisputed. No investor, no country can oppose. This is not good. No country will disagree to IFRS. Clear? Next. Now, I was speaking about basis of accounting. Next, talk about accounting. Basis of accounting. Basis of accounting. One is cash. One is cash basis, and second is accrual basis. Right? What is cash basis? only cash transactions, only cash, only receipt and payment are recorded, right? Accrual, all transactions, right? Whether money received or not, and whether paid or not, all transactions are recorded, right? Let's say income statement, for example. Now here cash accounting, income statement, I take only cash sales. There is no credit sale. But here we say cash and credit both. Clear? So that's my accrual accounting. So GAAP and IFRS requires you to follow accrual accounting, right? But I am working for a small LLC company, partnership company, right? My boss is a local. He will ask me, Aditya, how much cash we have? Generally, the small companies, the owners are more concerned about how much cash we have. They feel the cash is the profit. But cash is the profit for cash accounting. But cash is not profit under accrual accounting. Clear or not? So let's understand balance sheet equation. Let me also give some ideas about balance sheet. That's my balance sheet, right? Balance sheet, one side, okay. So balance sheet, one side assets, clear? And second side equity plus liability, clear? So there are three major categories of items in the balance sheet. Number one, equity. Number two, liability. And number three, assets. So can you make an equation? So can I say assets equal to equity plus liability? That's called accounting equation. That is based on fund theory. And based on proprietary theory, we just change assets minus liability equal to equity. So understand, this is called proprietary. Means what? Ownership. So under the ownership equation theory, we take equity. So equity is equal to assets minus liability. Clear? Under the fund theory, same thing. Assets is equal to equity plus liability. Both are same. Understood? This is under proprietary theory. This is under fund theory. Clear or not? Next. So we will talk about first. Let's understand debit credit concept. Transaction analysis. You are clear about debit credit or not? Okay, let me give some example. Let's say payment to supplier. Now assets, liability and equity, right? So payment to supplier, where I will have effects. Payment to supplier. Asset, what will happen? Asset will
Asset and liability.
asset will decrease. because cash is out.
Cash is going out. Yeah.
Liability also decreased. And equity, no change.
No.
Clear?
Yes.
Good. Now, cash, let's say cash sells. What will happen? Cash sells. Asset will increase. Cash came and sales going to affect income. Income going to increase equity. So equity also increase. Right? Now cash drawn. Let's say cash drawn from bank. You drawn cash from bank. Right? It's not liability. You have money in the bank. You are withdrawing. So it will, one asset will increase, one asset will decrease. Cash will increase and bank balance will decrease. So that's what you know, right? And we have known earlier, these are my accounting debit credit cycle, right? So all assets increase will debit, decrease will credit, right? We know all expenses debit. So let me write another way here. Debit and credit. So debit all cost and let me write under that itself. That's fine, right? And credit all incomes and gains, cost, expenses, and also losses. Debit, correct? Debit receiver and credit giver. Debit what comes in and credit what goes out. So you know all this, correct? Next. So let's go to example number 1. So what the question? Let's see. Example 1. Right. So let's say example 1. Yes. This transaction analysis, we know already, right? The debit credit concept we already know. So no need to waste time on that. Okay. Next. Now coming assets. Right? First we'll discuss about assets. What are assets? Assets are called resources. What do we say? Resources owned. Resources owned by the entity and from which economic benefit will flow to the company. We say assets. Mine. It's my asset. We own. Clear? So assets also can be two types. One is current assets and second non-current assets. What is current assets? Example, yes, cash and bank. Then receivables, inventory, right? Deposits, advances, right? Your prepayments, all are called current assets. Non-current assets also called long-term assets. Under that, we have two. What are they? One is tangible assets. Also physical. and here intangible. Now physical and tangible are called PPE. What is PPE? Property, plant and equipment. Example assets, cash, car, mobile, laptop, furniture, building, land, all are called PPE, physical assets, right? And physical assets are subject to depreciation. Intangibles, software, trademark, right? Royalty, then your license fee, your franchise fee, customer database are called intangibles. Intangibles subject to amortization. Clear? Simple? But land is not depreciated, right? Because land, what is depreciation? Ninhal, decrease in value due to wear and tear, right? And depreciation is allowed or charged on the business assets, assets used in administration and production, right? If assets are used for, let's say, investments, no depreciation. Your company has your own building, right? That building occupied for the business purpose, depreciation. But your company buying building, selling building, right? On those buildings, you are not depreciating. Those become inventory. Inventory is not subject to depreciation. Even though it's a building, but you are buying and selling. So buildings also became inventory, right? You know, a lot of car dealers, hundreds of cars in the showroom. Those cars are inventory. So the showroom company is not depreciating those cars. But those people who are in the showroom, the managers, they have been using the company cars. Those cars are depreciated. So depreciation is charged on those assets used for administration, production, or any other business purpose. But no depreciation is allowed on the trading items, on inventory items. We don't charge depreciation on the inventory. Clear or not? Next. So I think current assets, non-current assets, you can read them, right? Let's go to major topic. Liability. So similarly, liability also can be current and non-current. So what is current? Payable within 1 year. We say current liability. Non-current, payable after 1 year. Now, one thing I would like to say here, that current portion of non-current liability, current obligations. Now, short-term loan and current portion of non-current liability. What does it mean? You have a bank loan, right? Let's say as on December 25, you have 200,000 loan outstanding, right? And this loan you are going to pay, let's say April quarter, June quarter, October quarter, and December quarter. Example, right? And also in 2027, this is 2026, and so in 2026 you are going to pay, let's say, 150,000. This 50,000 you are paying after 1 year. This is my current liability. This is my non-current. Clear or not? Now tell me current liability and a non-current liability. Which is the problem? Current is bad or non-current is bad? You should have more current liability or more non-current liability. More non-current is better. Clear or not? Now suppose 150,000 dirhams is payable to the bank during 2026 and you have no money, for example, right? So auditors will look at the loan agreement. In the loan agreement, they find 150,000 payable in the next year, within 1 year. So you have to show as current liability. Yes or no? Now we know working capital is equal to current assets minus current liability. If current liability is more, so working capital will be negative. Yes or no? So we would like the current liability to be as minimum as possible. Right? So I have to pay 150,000 in next year. If I can have a refinancing agreement, same bank, I can say, sorry, sir, this I don't think I can pay 150 in the next year. Can you push it to the next year? This 150, can you take it to 2027? So this way, my current liability became zero. So I can push to my non-current. That's called refinancing agreement. So if you can show the refinancing agreement, you can classify the liability as a non-current. Because once you prepare financials with 150,000 current liability, this will be a problem. The working capital may be negative. By talking to the bankers for refinance, postponing the installments to the next year can help you manage your balance sheet. Right? So auditors will ask, why are you not showing 150 current liability? We already have an agreement with the bank. We don't have to pay 150 in 2026. We are going to pay in 2027. So that way you are able to avoid working capital crisis. Because your financials are going to the external users. They will see, oh my God, company has to pay 150,000 next year. That's a danger signal. So that is how you can manage your financials. Take some refinancing agreement and push the current liability to non-current category. Clear or not? Next. So these are the non-current liability items. Deferred tax liability, unearned revenue, beyond 12 months, non-current. Within 12 months, current. What is deferred revenue? Money in advance. You have not delivered goods and services. You have got money in advance. That's my deferred revenue. Okay. Now, items of equity. It means equity transactions. What are the components of equity? Right? One is your share capital. Yeah. So share capital, preferred stocks, additional paid-in capital. What is additional paid capital? Okay. So that's understand. Okay. Now share issue. shares are two types, right? One is ordinary shares and second is preference shares. Why we say preference shares? They have got lot of advantages. Lot of advantages. We say preference shares. They are also called a debt stock. They are not equity stock. Why? Because they get lot of advantages. So preference stocks are various. Are they there here? Okay, let me explain you. Those advantages are number one, fixed dividend. But ordinary, no fixed dividend. Clear? Now, second, redeemable. What do you say? Means they get money back. They get money back. Here, no such system. Right? Third, cumulative. What is cumulative? If in 1 year there is no profit and company could not pay dividend, the dividend will be carried forward to next year. That's called cumulative. So these are various preferences, advantages the preference shareholders enjoy. That is why they are called debt stock. That means liability. So preference shares are called debt stock. Clear? Now also preference shares also can be convertible. How do you say? Convertible to ordinary shares. So that is why we say hybrid stock. How do you say? Hybrid stock. So convertible preference shares are called hybrid stocks. So for some time they are debt stock. After some time they can get ordinary shares. So they became owner. So partly for some period they are lender. And after some period owner. So lender owner, we say hybrid security. So preference shares convertible share is called hybrid stock. Clear? Same like bonds also. Bonds also can be convertible. So bonds also called debt stock and hybrid securities. What is securities? Shares and bonds both are called securities. Next. Disclosure. So every financials, okay, let's see, understand also. I was discussing the issue of shares. Understand, okay? Now, issue of shares, right? Issue of shares can be by IPO. What is IPO? What is IPO? Initial public offer. Initial public offer means first time sale of shares is called IPO. Second, you can say now subsequent share sale, right? Can be by a right issue. What do you say? Right. A right issue. Then coming private placement. And third coming open offer. Right? So right issue we'll discuss, but private placement and open offer, they are not part of the syllabus, but let me explain you a little bit, okay? A right issue to existing shareholders. To existing shareholders. So existing shareholders have a right to apply for new shares whenever the company issuing new shares. So any new shares issued by the company must be offered to the existing shareholders. This is by law. So we say a right issue. Clear? Private placement, not to the existing shareholders. So company can sell the shares to within their own network. They don't have to sell to the existing shareholders. We say private placement. Open offer. Open offer is also to the existing shareholders, and existing shareholders, let's say right issue, what they can do, they can apply, they can sell the right entitlement. If you are an existing shareholders of MR, right, and MR is issuing right shares, so you will get intimation, Minhal, we are happy to declare a right issue in the ratio of 2:5. We say ratio. So if you have 100 shares, you can apply for 40 shares. Yes or no? 100 by 5 into 2, you can apply. So either you apply or you sell the right entitlement. The right entitlement also can be sold in the market. Right is an instrument. So you can sell the right entitlement in the exchange. Let's say Herat is buying right entitlement. So he will be entitled to apply for the right shares. Or you can just keep quiet, do nothing. Now open offer says either you apply or you lose. No sale of right. Right? You cannot do this. That's my open offer. Simple. Okay. Now we are in now share issue. Share issue. Every share we have something called face value. What do we say? Also called par value. Also called nominal value. Let's say 100. And issue price. Let's say issue price 120. Right? So this is called premium. We say additional paid in capital. What do we say? Additional paid in capital, APIC. Additional paid in capital. Right? But if the issue price is 90, that was premium 20. If 90, the discount will be 10. Clear? Now the question says how to make entry for that. Look, this example is from the old book. This example they have removed from the new book. But I know it is required. That's why I kept it here. Right? So company issuing 50,000 shares, face value 1 dirham and issue price 17. So face value is share capital is at face value. And premium will be at the 16 into 50. Clear or not? Simple. Balance sheet disclosure. These all are the disclosures. Now here I have just put a balance sheet, the comprehensive balance sheet. all the possible items, whatever possible in the balance sheet, all are mentioned here for you to have a idea. Okay. Now coming to income statement and also comprehensive income statement. One is income statement and one is, so let's understand now income, right? Income can come from two sources, right? One is operating income. We say revenue, right? Your income from core business. And here we say ancillary, non-operating ancillary. Means, let's say discount, rent, interest, dividend, bad debt recovery, commission, all are called non-operating income. Now, main business is called operating income, and that is called revenue. Clear now? Now, income statement and comprehensive income statement. So, what is income statement and comprehensive income statement? So, one is income and other is.
Your audio is not coming.
Coming, no? Hi, Manoj, can you hear me?
Sir, I can hear you. I can.
Yeah. So, Wilfred, can you hear me now? Wilfred? Hi, Wilfred. You have to log out and log in. Others can hear me. Okay, have a look at the screen. Session. Hi, Wilfred, can you hear me now? Okay, you will understand. So, income statement and comprehensive income statement. So, one is income and second is comprehensive income. What is comprehensive income? Means total, right? When I say comprehensive, it means grand total. So, this comprehensive income equals to, understand, income and other comprehensive income. Understand? Income plus OCI, right? Income plus OCI is equal to comprehensive income. Understand this? Clear? This comprehensive income, let's say CI equal to income plus OCI. What is OCI? Other comprehensive income. Now let us understand what are those other comprehensive income. So these are other comprehensive income items. These 5 memorize. Effective portion of cash flow hedge, unrealized holding gains and losses due to fair value adjustment of debt securities, translation gains and losses of financial statements of foreign operations, defined benefit plans, and revaluation surplus on long-term assets. These are comprehensive income. So basically, these items, understand, these items do not go to income statement. Understand? So these are ad hoc in nature. These are ad hoc in nature. For example, it says revaluation surplus on long-term assets. What does it mean? Let's say, for example, you have, let's say, building. In balance sheet, you have a building 20,000 cost. Right? Let's say accumulated depreciation, let's say 5,000. So 15,000 is your WDV. Yes or no? Vinal? The written down value. Right? So cost minus accumulated depreciation is called written down value. Yes or no? WDV? Written down value. Written down value. That's called WDV after depreciation. Now let's say market. Let's say market value is 18,000. So what will happen? So if your management has got two choices. Either to continue on the cost basis, on the historical cost basis. Cost is 20,000. Every year depreciation. That's called your historical cost basis. Or revaluation. Market value is 18,000. So how much increase? 3,000. Right? So now 3,000, when asset is increasing, right side increasing, left side also has to increase, yes or no? So that will be a revaluation surplus. This is also part of equity, but it will not go to the revaluation gain 3,000. No, it will not go to income statement. Yes. So we will make entry building account debit and revaluation surplus debit. So revaluation surplus is OCI item. Clear? Because this is mere book adjustment. Tomorrow, this market value can be also 13,000. Yes or no? So that will be revaluation loss. So that will be adjusted from here. Clear? So certain items are not realized. These are unrealized, which are unrealized holding gain or loss. So that is why I see there will be one more account called OCI item. Right? So revaluation, surplus, cash flow hedge. Now foreign foreign transaction translation means what? Now you have a factory in Sri Lanka, right? So every year you are going to convert to dirhams. That's called foreign financial translation. There can be gain or loss. That is also finding place in OCI statement. So these 5 items are OCI items, right? So how it is displayed? Let's understand. How are they displayed? So this comprehensive income means income plus OCI are called comprehensive income. This can be presented in 2 ways. One single statement, second separate statement. Now, this is my combined statement. I got my net profit. This my all my income statement items. This holding gain, that's my OCI item. I put in the same statement. We said combined statement. Clear? After the net income, I am putting my, that can be many items. I can put one by one, but in one statement. And second, we say two separate. So first to make income separate, then another statement, bring the income down, then you put separate. These are called two statements. Clear or not? Now, we will go to, yes, yes, both are called complementary. This is presentation, right? Either you can present in one statement, come to the net income and put the OCI in one statement, or you can make two stages. Means not two pages, one page, but two sections, right? Two sections. That's my multiple. That's my multiple statement. Okay, two separate statement. Next coming. Okay, so now coming income statement. Income statement, let's understand. Income statement, we have here income, right? This income can be operating and non-operating. Clear or not? So this non-operating also includes gains on disposal of assets. If you sold your building, sold your car, the gain is realized. But if gain is not realized, just now we saw building revaluation. So the revaluation gain or loss going to OCI, right? Same, let's say disposal of your building. Once you dispose, once you sell, it becomes realized. So realized gain and losses. We are using the word called gains. Why? Gains are for the non-current sale of non-current assets. Gains and losses, we say on disposal. We don't say sale. We don't say sale of building. We say disposal of building. Sale means core business. Understand the concept? I use the word sales for my ordinary business. I don't use the word sale of building. I say disposal of building. So gain on disposal or loss on disposal. So gain and loss on disposal, it becomes realized gain or loss. Once realized, it goes to income statement. As long as you don't sell, only adjust to the market value, we say revaluation gain and surplus or loss. That will go to OCI. So that is why I say OCI is a parking area. Just a service road. Income statement, main road. Clear or not? Next. Next. Now, income statement, this is not in the book. I have put here for you to understand how the income statement template looks like. Now, this is called vertical approach. Vertical template, correct? And this one is called, if I say income statement this way, we say horizontal. Right? Now the companies are preparing vertical statement. And this is called your top line. What do you say? Top line. So sales, cost of goods sold, gross margin. This template you have to memorize. Lot of questions on this coming. Right? Has remains sales. Sales of what? Sales of goods and services. And for a bank, Sales is interest income. Understand, right? So gross margin my sale minus cost of goods sold. Next, I will deduct SGA, sales, general and administration, SGA. Wilfred, okay now? I Wilfred?
Okay, now, okay.
Yeah, right. So my SGA is gone. I got EBITDA. What is EBITDA? Earning before interest, tax, depreciation and amortization. That's also called my operating profit. Then I have, let's say, non-operating losses. I will let's say gain. I will add them. Then out of this depreciation and amortization, I will take out first. Then I am remaining EBIT, right? Then I will take the interest out. Interest gone, then EBT, then tax out, then I got PAT, profit after tax. Clear or not? Then I have some here discontinued operations. We'll discuss now coming up. So what is this? Now this one is called income from continuing operations. Before tax, after tax. Now what is called discontinued operations? Let me just clarify that. Okay. Let's go here. I'll come back. Understand, let's fast. What is called discontinued operations? What is discontinued? Discontinued.
Stopped.
Stopped. Yes. So what it said, please understand the concept. Now suppose you are making balance sheet. Your balance sheet as on December 25. Clear? On December 25, you thought we have a mobile plant, right? And we want to sell them in 2026. We don't want to operate them. So by December 31st, the balance sheet date, your board has already decided not to use the plant to held for disposal. So already decided as discontinued. So this will be under discontinued operations. So this plant may be $20 million. There can be also liability, maybe let's say $7 million. There can be bank loan taken for this plant, yes or no? So 20 minus 7, so net 13 will be marked under discontinued operations. So this plant held for sale. Clear or not? Now 2026, in the income statement, if you sold this plant, right, this mineral, this plant is held for sale or not? Clear? So 2026, you are selling the plant. You can have some gain, maybe loss. How much net book value? 13 million. You can sell for 15, 2 million gain, or sell for 14, 1 million loss. That 1 million profit and loss you have to show separately. That's mine separate here. Right? Either gain or loss, you have to show separate, and from that then you get income tax benefit or expenses. So on this 4 million, your gain from the disposal, There is a tax payable or not? So I will pay the tax. Then my net income became 8 plus 1. That's my 1. Okay. 4 my income, 3 my tax. So net income is 1 million. So 8 plus 1, my total my 9 million. After that, coming comprehensive income, all those cash flow hedges, translation of foreign currency, foreign assets, your revaluation. So this is the step-by-step approach. You have to really memorize. So first you take income from operations, pay the taxes, because investors should know, right? If you club them together, then investors will not come to know. Now investors know that this year income was 8 million from the continuing operations. Next year this plant is already sold. So they should not expect similar income next year. That's why you show that this is income from the discontinued operations, right? So now this can be gain on disposal, right? Or also here, yeah. Okay, so whatever income is coming, you should show separately. So this is my template: income from operations, income from discontinued operations, and comprehensive income. That is called my total comprehensive income. Clear or not? Then that's my net profit margin. That's also called my net profit. So 10 million net profit. How much my income? My income was 100, my sales. So profit became 10%. Clear or not, Minhal? Don't worry, we'll go for break 5 minutes. Okay. Now 10 million profit for whom? Profit for whom? Owners. Owners means shareholders, right? And shareholders can be two types. One is my preference and second my ordinary. So who will get dividend first? Preference. So first I will give them their dividend, let's say 2 million shares, 10% of 1 dirham face value. So how much DPS? Dividend per share. How to calculate? Face value into dividend percent. How much face value? 1 dirham. How much dividend percentage? 10%. That became 0.1. And how many shares? 2 million. So total 200,000. That's my 200,000 is gone for the preference. So out of 10 million, 200 gone. This 9.8 million is for whom? For ordinary shareholders. Clear? Now, how many ordinary shares I have? 5 million. That's my capital structure. So this 5 million I am dividing, I'm getting EPS. What is EPS? Earning per share. Right? So what is EPS formula? Can you repeat? Net profit available for ordinary shareholders. Can you repeat? Net profit available for shareholders divided by number of ordinary shares. So EPS is never for the preference shares. EPS is only for the ordinary shares. Clear? So that is how we calculate. EPS means what? Earning per share means what? How much profit attributable to every ordinary share. That's called my earning per share, right? And earning per share is the last item, the bottom-most item in the income statement. EPS is a kind of disclosure. So in the income statement, even private company also, there is EPS calculations at the end. How much EPS per share? EPS amount, the figure is the the bottom most item in the financial income statement. Clear or not? Now EPS can be diluted EPS, general EPS, that we discussed in chapter number 2. Sorry, in part 2. Okay. Next. No exam, no same, no. See, profit is 10 by 100. My sale was 100. That's what. Example, yes. This dividend 10%. See, preference shares always come with dividend, fixed dividend. That is how it displayed. 10% preference shares means what? The preference shares will get dividend 10%. But ordinary, they never get fixed dividend. Ordinary shareholders do not have a right to dividend. Only preference they have got right to dividend. That is why we say equity capital at risk. Preference shares, if company getting bankrupt, they can get some money. But ordinary, nothing. So you may lose all your capital. But remember, out of 10 million, only 200,000 they are taking. 9.8 million you are taking. You are getting more benefit, more loss also. If company goes bust, bankrupt, you lose your capital. We say equity capital at risk. Clear? Next. This all costs and all, you know, or we will come back 1 second. So trading company, how to find out the COGS? Opening stock plus purchase minus closing stock. But in manufacturing, opening stock plus cost of goods manufacturing. So what exactly it is? Let's say you have a plant, right? So that's my, let's say, that's my plant and that's my warehouse. So now raw material came plus labor came plus fixed overhead. That's called my total manufacturing cost, right? Incurred during a period. Now, there can be something called WIP. Wait a minute, let me put it here itself. It's okay. Now, that's my total manufacturing cost. Clear? Now, once these products are completely manufactured, then can go to finished goods warehouse. Yes or no? So, basically, you can say any plant, there will be opening WIP, right? Also closing WIP. You can never expect the plant is completely clean. There is always something under process, right? End of the month, something under process, we say WIP. What is WIP full form? Work in process, not progress. Work in process. For construction companies, we say work in progress. On the road, you see the placard, work in progress. You don't see process. So process for the process manufacturing companies, right? So whatever you have opening balance plus direct material plus labor plus overhead is called total manufacturing cost, and opening WIP plus TMC minus closing WIP, that goes to COGM, that goes to finished goods warehouse. So this COGM is just like purchase, right? Manufacturing companies selling the manufactured goods. Manufacturing company, they don't buy and sell. If they're doing buying and selling, it means they have a separate trading division. But predominantly, they sell the goods manufactured by them. So whatever they manufacture, we say cost of goods manufactured. Clear? So that's why my formula, opening inventory plus COGM minus closing stock. Now what is COGM? Opening WIP plus, opening WIP plus my manufacturing cost minus closing WIP is my COGM. If no WIP, then COGM will be cost of goods sold, closing minus opening. Clear or not? Now coming cost of goods sold. Now cost of goods sold. Same thing, opening and closing plus COGM. So opening plus COGM minus closing, that's my cost of goods sold, right? So whatever, this is my manufacturing plant, my warehouse, right? So I am selling from here. So my opening stock plus cost of goods manufactured minus closing will be my cost of goods sold, right? So cost of goods sold can be found out in various ways, right? So let's understand quickly. You have to understand how to find out cost of goods sold, because questions are coming on that. Cost of goods sold. I can simply say quantity into cost. Yes or no? Simple. Another way, opening plus purchase or COGM minus closing. Right? So in the question example, in the question, you will see what is the information given. See, basically, what is cost of goods sold? Whatever quantity I am selling, suppose I sold 1,000 quantity. If I know my cost, let's say my cost is $10. So I know 10,000 COGS. But if I don't know this, then I go by this way. This is your direct way, this is your indirect way. Now, direct way, why I'm saying? Now, direct way, you have ERP software. Understand the concept now from here, right? We say cost flow. What do we say? Cost flow. If your company having solid ERP, whenever you make a delivery note, the cost is already, if you are maintaining ERP, means all the purchases you are doing getting updated, inventory getting updated, yes or no? Simple or not? If you are having ERP, whenever you purchase, inventory is changing, cost also changing. When you sell, when the goods are moving out, also going with the cost. So you get every delivery, you get a cost involved. That's my direct method. We say that perpetual method, a real-time method. Anytime any delivery note prepared, tuck, you will find same time that is a cost of goods sold entry happened. Clear? But if you don't have ERP, we say periodic method. We'll discuss again coming up, but let me clear it now. Periodic means what? We don't have ERP. So how to know cost of goods sold? The donkey way. Opening. How much opening was that? Sir, 2 million. Okay. Minhal, how much you purchased? Sir, 4 million. Okay, Herat, How much closing stock? Sir, 1 million. So opening plus closing, opening plus purchase minus closing, we take one figure as COGS. So if closing is wrong, my COGS wrong, right? And in this periodic approach, I lost tracking my invoice wise profit. So periodic method, I get only one cost of goods sold amount for the whole period. But in ERP, if I have ERP, then every invoice is having cost of goods sold real time. So this is your cost of goods sold calculation. You have to see in the exam what is in the question given. So opening plus purchase minus closing is equal to cost of goods sold. So anything can be found out from the equation. It can be any one missing, maybe if closing is missing. So opening plus sold or minus COGS is equal to whatever. So from the equation, opening plus purchase minus closing is equal to COGS, that you have to memorize. Clear or not? Okay. We'll go for a break now quickly. We come back and we start. Okay, we come back, then we start example 1.2. Okay, we are going for a break now. All of you, I will Wilfred, Ajmina, Amandeep,
Okay,
are you
sir.
there? Yeah.
Okay.
Going for a break for 10 minutes. Come back at 11:50. Okay.
Okay.
Thank you.